Welcome, and thank you for attending PHADA's webinar on HOTMA implementation. Before we begin, we'd like to remind you that registration is now open for PHADA's 2026 Annual Convention and Exhibition, June 10th through 13th in Chicago. At this year's annual, we are introducing the theme, The Power of Story, the Impact of Advocacy, along with some exciting new features, including advocacy labs, some more favorable time adjustments to the committee meetings based on your feedback, a field trip to the Public Housing Museum, and much, much more. Be sure to check out the online agenda at www.phada.org/ACE26. We now take a moment and review the logistics for today's event. We will be taking questions at the end of the presentation. At any time during the webcast, please use the Q&A box in the toolbar to submit your questions. We ask that you not use the chat, as we're not going to be monitoring that for the audience participation. We have posted a PDF of today's presentation in the chat, which you can access now. A recording of the webinar will also be available on PHADA's website following today's presentation. And finally, as a reminder, the discussions in this webinar are not for media use. For quotes or more information, please contact PHADA directly. And now, I'd like to introduce Michael Webb, Deputy Executive Director, who will lead today's presentation.
Good afternoon, everyone, and thank you, Blake, for that wonderful introduction, and good morning to our folks on the West Coast and in Hawaii. As Blake just so ably introduced me, I'm Michael Webb. I'm the new Deputy Executive Director at PHADA. However, I've been with the association for about 3.5 years. And so for the next 50 minutes or so, what I'm going to do for the attendees is I'm going to be providing an update in terms of where we are with HOTMA, particularly the implementation of sections 102 and 104. I'm going to give a bit of background, and then we're going to go through the HOTMA implementation notice, which is PIH 2023-27, which was just updated in the last couple of weeks. We'll be talking about that overall notice and also the updates that were published recently. So in case you are new to the industry and you're just wondering what in the world is HOTMA, HOTMA stands for the Housing Opportunity Through Modernization Act of 2016. It was passed, or excuse me, it was signed into law on July 29th, 2016, which means in only a matter of months, it will be celebrating its 10th birthday. I plan to personally go out to a happy hour on that date to celebrate the fact that it was signed 10 years ago and is still not fully implemented. As I mentioned earlier, we're going to be talking about the upcoming implementation of sections 102 and 104, which concern new income and asset rules. However, there still is an entire section of HOTMA section 109, that has not been implemented yet at all. And while we're not going to be talking about it today, I do want to make attendees of the webinar aware that there are major changes to project-based voucher rules that were put into effect in 2025. Please consult those. We've got some really great materials on PHADA's website if you are curious. But I would say overall, those rules make the project-based voucher program, I think, much more appealing to a wider variety of housing authorities. So going back to HOTMA sections 102 and 104, which is really what the rest of this webinar is going to be talking about today, just as a very broad overview, they make many changes to housing authority policies. There are new income definitions. There's a new definition of what income is. There are changes to when housing authorities will conduct recertifications, particularly when tenants have income changes between their annual recerts. And there's a new asset limit policy that housing authorities will have an option to either apply to all or some of their currently assisted families. The interest in HOTMA is really broad because HOTMA impacts many different housing programs. So in terms of what housing authorities implement, it has a lot of effects on public housing and on both the tenant and project-based voucher programs. But it also includes HUD multifamily programs, including project-based rental assistance, or PBRA, the home program, CDBG, HOPWA, Housing Trust Fund, and low-income housing tax credits. And then the final thing that we're going to be talking about in the following slide is that HOTMA, in order to be fully implemented, requires major software updates, both on HUD's end and in terms of what software vendors like Yardi, Emphasis, MRI, Conso, and the like, Webb, those software products that they all provide to housing authorities. So in terms of HOTMA and HIP, For 10 years, HUD worked on developing a system known as the Housing Information Portal, which was going to be the successor system to IMS PIC. However, earlier this year, HUD suspended development of HIP after 10 years and about $30 million spent. Since suspending the development of HIP, HUD has instead worked to update IMS PIC, trusty old PIC, which is now probably 25 years old at this point, to accept HOTMA compliant forms. So again, the revised 5.8 form that includes the new HOTMA income and asset rules. HUD is still working on that update. Software vendors, some of them are testing that update, but even if HUD is able to update PIC to accept these HOTMA compliant forms, the third-party software vendors that most housing authorities use are then going to have to go in and update their own systems and their own business rules so that your staff at the housing authority can enter HOTMA compliant data into those forms, and then that HOTMA compliant data can then be transmitted to HUD. So again, there's really two factors at play here. One is that HUD has to implement the systems on its side, which I think, quite frankly, is a lower lift, or a lighter lift, I should say. And then the software vendors that most of you in the audience work with are then going to have to update their systems, which is going to be a very big lift and is going to require a lot of time and energy. So over the years, HUD has made a number of false starts in terms of HOTMA implementation. About 2 years ago, there was a timeline that was produced. We all got ready for HOTMA. A lot of people sent their staff to trainings, and then HUD backed away and said, we're not ready yet. At that time, they were still working on HIP. HIP was not ready yet. This isn't going to work. We got to try something else. And so they pulled all of that guidance, and we've kind of been in the dark in terms of HOTMA implementation. However, in a meeting 3 weeks ago, it'll be 3 weeks ago tomorrow, HUD staff on a call with PHADA, other industry groups, and the software vendors announced that the HOTMA compliant date for non-moving to work housing authorities that are not using the family reporting system, which is the vast majority of housing authorities out there. So if you're non-MTW and you're not using FRS, HUD is currently targeting a HOTMA compliance date for sections 102 and 104 of January 1st, 2027. So this upcoming January 1st. I should note that HUD at that time, 3 weeks ago, said that they would be imminently, that was their own word, imminently, publishing a notice that established the Jan 127 compliance date. 3 weeks later, and I checked an hour before this webinar, they have not yet published that notice. I don't know when it's going to be published. I assume it is coming in the next couple of weeks. But every day they delay publishing that notice, it's going to only lead to more chaos and confusion for your agencies. And that's why PHADA has very strenuously argued against this compliance date timeline. Because it's unworkable for the software vendors, it's unworkable for you as housing authorities, and quite frankly, it's going to be unworkable for your residents because, as we're going to talk about in the second half of the presentation, there's a ton of changes that are coming to how you're calculating income, and residents' incomes are going to be changing. And what I've always said when I do these presentations in person is the last place you want your residents to know that their rent is changing is when they're sitting in the office with your research specialist with their box of receipts, which we all know residents love a box of receipts. I should also clarify that HUD's intention with this compliance date is that it would apply to all research with an effective date of Jan 127. So what does that mean for housing authorities? Most housing authorities work 90 to 120 days ahead, which means that your letters to your tenants for Jan 1 research are going to go out for many housing authorities on September 1st, which means, again, the craziness of this timeline. It means that you guys are going to have to be ready to send out HOTMA compliant letters on September 1st for most of you, maybe October 1st. It is an unworkable timeline, but this is the reality, at least of what HUD has told us in that meeting. Again, they still have not published it, but they've given us the green light to tell our members, and so that's why we're here today. For housing authorities that are MTW expansion agencies, you guys are HUD's next priority in terms of the HOTMA compliance date. They don't know when. They assume it's going to be a few months after Jan 127. I also know that many of the MTW expansion housing authorities are sitting on multiple years of 5/8s that you have not been able to submit to PIC. HUD has not developed any guidance in terms of what you're going to do with those 5/8s. For the 39 original MTW housing authorities and for any housing authorities that are using FRS, which are primarily very small agencies, HUD has no guidance in terms of when you would begin to implement HOTMA. HUD is committed to updating FRS to be HOTMA compliant, but there is no timeline for that going forward. So moving on to really the bulk of today's presentation is what I want to do is I want to do a very quick, in the next 40 minutes or so, overview of the key HOTMA policy updates that are coming. I should clarify, this is just a preview. There are lots of changes that I won't be able to cover today in the next 40 minutes. As I said in some of the in-person trainings I did last week, you can pay some very well-qualified, very reputable consulting companies to go to multiple days of HOTMA training. Those are very informative. I can't cover the amount of ground that they're covering multiple days in the next 40 minutes, but I'm going to try my best. I would recommend everyone, again, to consult the HOTMA implementation notice, which is PIH 2023-27, which, as I mentioned earlier, was just updated in the last couple of weeks. There are lots of really great examples in that. Because of the fact that this is going to be a somewhat summarized presentation, I won't have time to go into examples, but there are some really great examples in the implementation notice. And I should also say that the organization of the topics I'm going to talk about today follows the order of topics that are in that implementation notice. So if you have it brought up, or if you want to bring it up right now and go through section by section with me, you'll be able to follow along. And throughout the presentation, I have put out a few medals on the slides for the three things that I think are the toughest things for agencies to implement going forward. I should also say before we get started, these changes are going to be, I think, overwhelming to a lot of folks. The vast majority of them, as I mentioned earlier, are not going to come into effect until Jan 1, 27 at the earliest. There were a few things that were implemented in July of last year, and I'll be sure to point those out as we go forward. So starting with attachment A of the HOTMA implementation notice, again, that's PIH 2023-27. The first topic they talk about is the asset limitation. This is a new policy that is going to apply to all new admissions after the HOTMA compliance date. And as I'll talk about on the following slide, it can apply, so this is a discretionary policy. It can apply to all, some, or none of your currently participating families, again, on that HOTMA compliance date. So the specific asset limitation is that housing authorities will be prohibited from admitting any new family that has over $105,574 in net family assets. That's going to be adjusted for inflation annually, and the new figure should be out in October of this year, give or take. Housing authorities will also be prohibited from admitting any family that owns real property that is suitable for occupancy. Now, I do want to clarify that there are a lot of caveats to that real property stipulation right there. So in order for a family to be denied admission, they must have present ownership in the property, legal right to reside in the property, and the legal authority to sell the property. The property must also be proximate to jobs or education and must meet any accommodation needs. So if you're a housing authority in New York and you're trying to admit a family that has property in California, and that family has a job in New York or they're going to school in New York, because they're obviously not going to be able to commute from their property in California, you will still be able to admit them. Or, and I know this is something that I ran into a lot, you've got a family or an elderly individual who wants to come into the housing authority. They own property, but it only has one bathroom, and that bathroom is upstairs, and they have mobility issues. So you still will be able to admit those families as well. So again, I think going forward and just thinking about how this asset limitation is going to play out on the ground for your families, I would say the vast majority of admissions will be denied for the net family asset amount restriction, not so much for the real property restriction, just because there's so many caveats to that. I think it's going to be really difficult to enforce for any new admissions. So moving on the previous slide, I noted that the asset limit will apply to all new admissions, but it can apply to either all, some, or none of your current families. So this is a discretionary policy that your housing authority will need to adopt. Your options really are total non-enforcement, meaning that you will not enforce any asset limit for your currently assisted households. Enforcement, meaning that if any of your currently assisted households are in contravention to that asset limit, you will terminate their assistance. Limited enforcement with an option to cure, meaning that if you find a family that is in contravention of the asset limit, You give them up to 6 months to come into compliance. I think housing authorities that choose this option will choose it because uh, retirement accounts under HOTMA are going to be exempt from asset calculations. However, in order to be exempt, that retirement account must be IRS certified as a retirement account, like a 401k or an IRA. And I know a lot of the families we serve have their retirement savings in a savings account at Citibank. So if they have their retirement savings in a city account at Citibank, and you're trying to apply the asset limit to them, they could be in contravention if that amount in that account is over the asset limit. So by providing them the option to cure, you're allowing those families to transfer that asset into something that's going to be exempt from the asset limit, like a trust or a retirement account. And then the final option for housing authorities is limited enforcement with exceptions, which means that you apply the asset limit to certain households and you exempt other households from the asset limit. So for instance, you could exempt your elderly families from the asset limit while you can apply it to your non-elderly families. That's an option that housing authorities can choose. The only thing to be careful of here is just make sure that you do not go against any fair housing laws in terms of applying the asset limit to only some of your families. So that's attachment A in the HOTMA implementation notice. Moving on to attachment B, income calculation. So there are extensive changes to how residents' incomes will be calculated after HOTMA goes live, including a new definition of income, which sounds very existential, but it is true. The new definition of income specifically lists which types of income are excluded, and anything that's not in that list is by definition included in a family's income. This is not necessarily a training procedure. I'm trying to train you on as much HOTMA policies as I can, but I will just say, taking a very 30,000-foot view of this, staff are going to need intensive training on the new income procedures, and housing authorities are going to need to message those new income changes to residents. Because like I said earlier, the last place you want a resident to find out their rent is changing is when they're in the research office with a research specialist. Key changes among many, just some I want to highlight. So there are new ways to calculate student financial aid in terms of how it applies to income. There are changes to home-based care payments. So in general, that the income exemption for home-based care payments is getting broadened. So more types of home-based care payments are going to be exempt from the income calculation. And there's also a new definition of non-recurring income. So there's a new definition of how you look at non-recurring income and what gets included in the income calculation and what gets excluded. There's also new procedures for in terms of unemployment, which is always going to be included in income, and workers' comp, which is always going to be excluded. The one thing I'll note here in terms of those specific income changes is many of them actually went live in July of last year with the HOTMA partial implementation notice. So just be sure that for those new income inclusions and the new income definitions that you are applying those because they did go live starting on your July 1 research last year. And again, there's a ton of examples in the HOTMA implementation notice. I don't have time to go through all of them right now. But again, I think a lot of those specific changes, they're going to impact I think a relatively small number of your families, but it could be a very big impact for some of them, particularly if they're getting student financial aid. So deductions and expenses. So those are changing as well. So the elderly and disabled deduction is now higher, and both it and the dependent deduction are adjusted annually for inflation. So if HOTMA were live now, the elderly and disabled deduction would be $550, and the dependent deduction would be $500. And like I said earlier about the asset limit, these are going to be subject to inflationary adjustments annually. They're only going to change in $25 increments, so they won't change every year. But we will find out in October if we'll have new elderly, disabled, and dependent deduction amounts starting in January. There's also a change to the child care deduction. Not so much the deduction itself, but in terms of who can get it. So the child care deduction remains the same. However, housing authorities will need to have a hardship policy for families who have exhausted their eligibility for the deduction. For instance, if a family is not working and is not looking for work, but paying for childcare constitutes a hardship because they're unable to pay their rent. Housing authority must have a hardship policy in place so that those families, again, who would not otherwise be eligible to claim the childcare deduction, can receive it. So that's something that you're going to need to have in your policies. And you're also going to have to educate your staff in terms of how to adjudicate those hardship requests for the childcare deduction. So I mentioned earlier, I put some medals on some of these slides for what I think are the three hardest things when HOTMA goes live. And so we've come to the first one. So the third place medal, so I think this is probably the third hardest thing for housing authorities to implement when HOTMA goes live, is the new medical expense and attendant care and auxiliary apparatus deductions. Try saying that 10 times fast. So the easiest thing on the slide, so the disability expense deduction is now being renamed to the attendant care and auxiliary apparatus deduction. The threshold for households to claim either of these deductions is increasing from 3% to 10% of their annual income. So what does that mean in practice? That means in practice that fewer households are going to be able to claim these deductions because the income threshold is higher. And the households that are claiming them are going to be able to claim less in terms of the deduction. Now, I played around with some of the numbers, and I would say in general, most of your elderly families are going to see their rent go down because, as I mentioned on the previous slide, the elderly deduction is going up. It's going up to $550 this year, and it might even be higher next year. However, there are going to be some situations, and if you do have elderly or disabled families claiming these deductions, I think it's really going to be imperative for housing authorities to work with them ahead of time. There could be situations where either an elderly family's rent is going to stay the same while a lot of their peers are going to be decreasing, or there are some edge cases where I think elderly families' rent could be going up because of this increased threshold for claiming this deduction. They'd have to be a particularly wealthy elderly family with particularly high medical expenses, but it could happen. And I also should say, I know we at PHADA do like to criticize HUD a lot, but this provision itself is coming straight from the HOTMA law. HUD really had no discretion in terms of implementing it. HUD, however, seeing that this jump in terms of the income that can be claimed for this threshold could cause a hardship to families, has implemented what they're calling a phased-in relief. So if at a family's first recert after HOTMA goes live, so let's say HOTMA goes live July or Jan 1, 27, a family comes in for their annual recert in March, and they're currently claiming this deduction. At that first recert, they can claim expenses over 5% of their income for 12 months. So they go from 3% to 5% at their first post-HOTMA recert. And then 12 months later, it goes to 7.5% of income. They get that deduction for 12 months. And then finally, 24 months after their first post-HOTMA recert, they're finally at that 10% threshold. This is, of course, going to be something that your software vendor is going to have to track for you. And it's certainly something that I would be educating your staff about in terms of implementing this phased-in relief. HUD is also implementing a new general hardship deduction for both, again, the medical expense and the attendant care and auxiliary apparatus deduction. So if a family can demonstrate that those expenses are a hardship, then they may deduct expenses over 5% of their income for up to 90 days. So your housing authority is going to need to have a hardship policy in place, and your staff are going to be trained on that. There's also discretion in terms of whether a household can repeat that hardship after that first 90 days. So you're also going to need a policy on if they can repeat it, and if they are going to repeat it, how do they do that? Do they need to come back into the office and prove the hardship? Does it renew automatically? These are all policies that you're going to have in place before HOTMA goes live. The one thing I will say is if a family is in the phased-in relief period, so let's go back to the example I mentioned earlier. Let's say they're in that second year and they're currently deducting expenses over 7.5% of their income. They come into the office, they say it's a hardship, they can't pay their rent, and they want to go back to 5%. After they go back to 5%, once that general hardship is exhausted, they can't go back to 7.5%. They've got to go all the way back up to 10. So that's going to be something that's going to be important to message to your families. Again, it probably won't be a large number, but those small number of families who are in that second year, that 7.5% phase, and they want to come in and it's a general hardship and they're going down to 5%, they can't go back to 7.5% after that. They've got to go straight back up to 10. So again, you can probably see from this explanation why this got a third place medal, because it is going to be very complicated for your staff to implement. It's going to be very complicated for you to message to your residents. But again, when I mentioned earlier, there's a huge resident communication burden that HOTMA imposes on housing authorities. This is probably one of the top 2 or 3 issues that housing authorities are going to have to communicate to their residents, particularly their elderly and disabled residents. So moving on, and the hits keep coming because we are now at the second hardest new HOTMA policy, which are treatment of assets. So under HOTMA rules, now assets are either going to be classified as real property or as personal property. Real property is home, a land, or equity in property. The net cash value of that property is an asset, and that net cash value is always included in asset calculations unless the household does not have legal authority to sell the asset. And really, the only instances where a household would not have legal authority to sell would be if it's in a situation that certainly we ran into a lot when I worked in the South, called heirs property, where you've got a bunch of family members who own property, but they don't know what percent of the property they own. They can't really sell it because no one knows how much they own, or if that property is currently in probate. However, aside from that, those are really going to be the only instances where a household does not have the legal authority to sell. Even if 3 siblings own a property equally and they each own a third, in theory, that one sibling could sell their third for 33% of the net cash value. The one thing I also want to mention here is that this definition of real property is different from the definition we talked about earlier with the asset limit. So the asset limit only applied to real property suitable for occupancy. So a home that they could live in that was proximate to their job or employment and that met their accommodation needs. Real property here, in terms of how we calculate income from assets, could be that home, it could be land, or it could be equity in property. So it's a different type of property that we're talking about here. The other way we're going to be treating property after HOTMA goes live is personal property. So all property is either real property or personal property. Personal property is everything else. So it could be tangible, like an ATV or a car that they're not using to commute to work every day, or it could be intangible, like a savings account. HUD is further under HOTMA dividing personal properties into necessary and unnecessary. And I personally am not a fan of these labels. I think they're going to lead to confusion and I think some messaging problems for HUD. But this is the language that they've chosen to use. So necessary property are items essential to occupancy, employment, education, or wellness. It could be a car that's used to drive to work or school or the grocery store. It includes personal effects like clothing. It includes any item that has religious or cultural significance, like a wedding ring. And it includes medical equipment. Unnecessary personal property is everything else. So it includes bank accounts, recreational vehicles like ATVs, collectibles. As I mentioned earlier, this is, I think, a messaging issue for HUD because I don't think we want to be telling our residents that having a savings account is unnecessary, but it's the language that HUD has chosen to use. I should also clarify earlier, should have clarified earlier that retirement accounts for this purpose are considered necessary personal property because they are excluded from asset calculations. I don't have enough time today to go into trusts. Trusts have very complicated treatment under HOTMA. Broad rule of thumb is if a trust is not under the control of the family, then it is excluded from assets, and all distributions from principal are excluded from income. However, if the trust is under the control of the family, for instance, the grantor is in the household, then it is considered an unnecessary personal property. It's included in net family assets, and the income earned is included as income. But please see the implementation notice for the full treatment of trust because it is, we could have spent an hour talking about trust, quite frankly. So in terms of how we think about assets and whether they are calculated as income under HOTMA, so as I mentioned earlier, assets are either real property or personal property. Personal property is further divided between non-necessary personal property and necessary personal property. And then NFA stands for net family assets. And so that really is the ultimate asset calculation for HOTMA. And we'll see on the following slide how that plays out in terms of a family's income from assets. So real property is always included in net family assets, again, unless the family does not have the legal authority to sell, like for instance, it's in probate or it's heirs property. Non-necessary personal property, those are things like ATVs, collectibles, checkings and savings accounts, are also included in net family assets. And then only necessary personal property, so that's personal effects, a car used to get to work or the store, medical equipment, items of religious significance, only those necessary personal property items are excluded from net family assets. So now that we know what are net family assets, how are we treating them and how is that changing under HOTMA? So if we start in the top left of this flowchart, and this flowchart I stole from the HOTMA implementation notice, net family assets exceed $50,000 adjusted by inflation. So that the asset threshold is going to change every year. So for the majority of our families, they have fewer than $50,000 in net family assets. I'll put that out there right now. So if the answer to that question is no, which it will be for the majority of our families, we go down, and the only income from assets that you're going to be recording on the 5/8 for those families is actual income. So you're not going to be imputing any income. Actual income from, again, for most of our families will be any interest they get on a checkings and savings account. A new policy under HOTMA, so not only is it raising the threshold to $50,000 from the current $5,000, but if a family is in that category where their net family assets are less than $50,000, a housing authority can choose to allow the family to self-certify their assets 2 out of every 3 years. And then the housing authority only has to do a third-party verification of assets once every 3 years. So again, I think that is probably something that's going to make our lives a bit easier. And again, for the vast majority of our families, those who have net family assets under $50,000, the only income from assets we're going to be recording on the 5/8 is any actual income they have, such as, again, interest from a savings account. For the relatively fewer number of our families who have more than $50,000 in net family assets, we're going to go to the right on the slide, and we're going to divide all of their assets between those that we have actual income, so again, interest payments, for instance, or no actual income, so if they own land. So if they're in that bucket where they have over $50,000 in net family assets, in terms of their income from assets, you're going to include all of the actual income. So for instance, all of the interest payments they receive. And then for the remaining assets they have, you're going to impute income using HUD's passbook rate. And that passbook rate is updated every year, just like the asset limits, just like the deductions. It's available on HUD's website. And there should be a new passbook rate published in October of this year as well. If a family is in that bucket of also having over $50,000 in net family assets, the housing authority must still do third-party verification of their assets every year. So again, I realize this is a complicated flowchart. This is a very complicated issue in terms of housing authorities, how they're going to calculate income from assets. Again, I would just say, going back to basics, the vast majority of our families have less than $50,000 in net family assets. For those households, the only income from assets that gets included on the 5/8 is the actual income they receive, which again, for most of our families, is going to be interest payments on a savings account. And housing authorities can accept self-cert of those assets 2 out of every 3 years and only have to third-party verify. For the households, the relatively few number of households we have that have over $50,000 in assets, it is going to be a bit more complicated. You are still going to include the actual income from assets, so interest payments, for instance. However, for those assets that do not have income, you're going to have to impute the income using HUD's passbook rate. And again, please see the HOTMA implementation notice. They've got some more examples as well. But there's a reason this got the silver medal in terms of the second most complicated topic in the HOTMA implementation notice. And now, for the most complicated topic in the HOTMA implementation notice, we turn to changes to interim re-examinations. So broadly, from a 50,000-foot view, there are extensive changes to how housing authorities will conduct interim recertifications after the HOTMA compliance date. There are lots of new discretionary policies, so it's important for housing authorities before that Jan 1 compliance date to make sure that they have their discretionary policies where they want them to be. And HUD has debuted a new reexamination type called a non-interim reexamination, or as I call it, a non-interim interim. The broad picture of these changes, the elevator pitch, I guess, for these changes, is that families can continue, just as they have always done, families can continue to request an interim for any change in income they have since their last annual reexam. However, there are now times where housing authorities can decline to process that interim if it doesn't meet certain thresholds. So I know, because I always ask this question when I do in-person trainings, I know housing authorities have residents who come to the resort office every time their hours change by just a little bit. There are now going to be situations where housing authorities will not process an interim, even if a household has had a small change in income. And so for an example of that, let's start with the less desirable option for a household. They have a decrease in income. So if a household comes to you and their hours have been cut, they have a decrease in income, housing authorities may, so this is discretionary, establish a policy to not conduct an interim reexam if a family's income decreases by less than 10% of their current adjusted annual income. This is, again, a discretionary policy. Housing authorities may set that threshold lower or not establish a threshold and continue processing interims just as they always have. However, the limits on this discretion is that the threshold cannot be higher than 10%. So it can be 10%, it could be 5%, it could be 3%. And the threshold must always be a percent of adjusted annual income. So you can't say $500. It always has to be 10%, 9%, 8%, yada, yada, yada. Again, I do want to clarify, this is a discretionary policy. I think if implemented, it could result in less work because you would be processing fewer interims, although I don't think as much less work because you'd still have to verify that the income change still met those thresholds. And housing authorities, again, have discretion to not implement a threshold at all. So if you so choose, your housing authorities can continue to process interims as you always have, where any change in income, any decrease in income triggers an interim re-exam, you process the interim, and the tenant's rent decreases. But again, it's something that I think if you have chosen to implement one of these policies, just make sure your plans are updated appropriately, your staff are notified and trained of the new procedures, and I think certainly your residents are also aware that these small changes in income might not trigger their rent to go down. So what about the more desirable option? Let's say one of your tenants increases their income. So housing authorities must not, so this is non-discretionary, this is a mandatory policy. Housing authorities must not process interims for income increases if the cumulative increase since their last annual is less than 10% of their unearned income, meaning non-wage income, or there is any increase in earned income. So one of the things that came into effect with HOTMA and HUD fully implemented starting in Jan 1, 2024, is they got rid of the EID. So the earned income disregard, it was a pain to implement. Housing authorities, I think, were generally happy that it went away. The trade-off for HUD getting rid of the EID is we now have this policy where if a household increases their earned income, meaning their wages, between annual recerts, the housing authority cannot process an interim for that. So the household gets to enjoy their increased wages until their next annual re-exam, in which case their rent will be reset to the higher amount. That first bullet point refers to any increase in unearned income, so non-wage income. So if a household has a small increase, for instance, in their child support payments, if that increase is less than 10% of their total income, the housing authority cannot process an interim. However, let's say their child support goes up a little bit in 1 month, and then the next month their alimony goes up a little bit more, and now the cumulative increase is greater than 10%, then the housing authority can process an interim. And again, I do want to clarify, both of those policies are not discretionary. However, there are two discretionary policies, which are on the bottom two bullet points of the slide, that could complicate things here. So let's say your household has a recert on Jan 1, 27. They've got a job, they're making $20,000 a year. Fine. We process the recert January 1, that's their annual. In March, they lose the job. So you process an interim decrease going down. And then in June, they get a new job and they're making $30,000 a year, let's say. Housing authorities can, this is optional, have a policy to process an interim for an earned income increase in that situation. So the family previously had an interim decrease in earned income. Now they're having an earned income increase. Housing authorities can choose to process that interim and raise their rent back up. Housing authorities may also not choose to process that. That's a discretionary policy that you're going to have to make sure is in your policies, and your staff are educated on the implications of that. There's a second discretionary policy that housing authorities can adopt a policy to not conduct interims for unearned income increases in the last 3 months of a re-exam cycle. So again, let's say a tenant's got an interim or an annual exam coming up in January. In November, their child support gets bumped up. The housing authority can have a policy in place that, we're not going to process that interim. We'll just capture it on your next annual. And again, those policies just need to be in your ACOPs and your admin plans, and your staff are going to need to be educated because, as you can probably tell from having to explain this to a computer screen, it is a very difficult policy to implement and I think to message to residents. And I think having examples for your residents and for your staff, quite frankly, is going to be really, really important. So about 2 weeks ago, HUD put out a new notice, I think it's 2026-09, and revised the HOTMA implementation guidance, the HOTMA implementation notice, 2023-27. And the reason that those documents were published were because of this slide right here. So HUD has changed its guidance in terms of how housing authorities process interims related to changes in household composition. So for any changes in household composition, housing authorities should ignore those income change thresholds, so either the 10% down or the 10% up, and process a full interim re-exam to both add or remove household members, add or remove any deductions that might be associated with those household members, and incorporate any changes in unearned, that is, non-wage income. There are some exceptions of this, though. So if the change is in the last 3 months of the re-exam cycle, and the change would result in an increase in annual income, and the housing authority has a policy not to conduct interims in the last 3 months, a lot of ands in there, the housing authority would not process an interim in that situation. If the change results in an increase in earned income, the housing authority cannot process the interim adding the earned income. You would just process the interim adding the family member. So again, let's say hypothetical. So let's say we've got a tenant. She lives on her own. She gets married. Her new husband has a job that pays $30,000 a year. He moves into the unit with this $30,000 a year job. In that situation, the housing authority would process an interim to add the husband to the household. However, they would not add the income, the wage income, until the next annual re-exam. There could be an exception, again, going back to that previous slide, if you've got the policy about interim decreases, that's going to be an edge case. I wouldn't stress too much about that right now. In those situations, the housing authority should only process an interim to add the family members, not to incorporate any increases in wage income. So it gets very, very complicated here. It's going to be a major staff training exercise just to make sure everyone's on the same page in terms of what to do in these situations. I will say there are examples in the HOTMA implementation notice. This is attachment I of notice 2023-27. Some of the examples aren't great. Some of them are good, some aren't great. The one that I specifically got clarification from HUD is the one I just mentioned. So in the event that someone moves into the household and they have wage income, and let's say they don't have anything else going on, keep it simple, the housing authority should process an interim just to add the household members, not to add the wages. And the wages would not be captured until their next annual re-exam. Again, this is what HUD told me, not saying I agree with that interpretation. As I mentioned earlier, there's now a new type of re-exam called a non-interim re-exam or a non-interim interim. This will be used when a family experiences changes that do not trigger an interim, but should be reported to HUD. I will say, if you've been with HOTMA implementation for the past 4 years, give or take, HUD initially, I think, had big plans for this type of re-exam, that we would be processing a lot of non-interim re-exams. I think overall, HUD's guidance in the last 4 years has narrowed the situations when non-interims are going to be processed for families. In general, it's going to be for adding or removing various hardships or processing contract rent changes that don't correspond to an interim or annual re-exam for your voucher households. HUD is now telling us that these non-interim re-exams will use the interim re-exam code on the 5.8, but there will be additional information reported alongside with it. So moving on, we are in the home stretch. And so this is something that I brought up in all of my in-person trainings. The impacts of these new interim policies on folks in the family self-sufficiency program. So I would say the more erudite members of the audience have probably realized that these new HOTMA policies mean that families in FSS will escrow significantly less because we will not be processing interims for increases in wages. In addition, the HOTMA implementation notice specifically prohibits housing authorities from conducting an interim when enrolling a family in FSS. So I know for a lot of housing authorities, and I think this is a good thing, right before the family gets a job, you do an interim, and then the family gets the job, and that wage income is now captured in their escrow. The HOTMA implementation notice specifically disallows housing authorities from doing that. So because families are just going to, in general, have fewer interims for increase in wages, the escrow amounts are going to be much less, and this is something that your FSS coordinators are going to have to work with the families on. Now, granted, that money will be in their pocket, so it's not like the money is going away, but it's going to impact families, and if you guys have any FSS matching programs for escrow, it could impact those matching programs as well. So you might need to rethink some of your partnerships, particularly, I know a lot of housing authorities have partnerships, for instance, with banks to do down payment matching on FSS escrow, and that's something that you might have to be rethinking for your families. So just a handful of slides left. We'll try to plow through these pretty quickly. New verification procedures. So there's a new 9886A form. This is the consent form. It is now a lifetime form. Household members only need to sign it when a family member turns 18 or an adult moves into the household. Family members may revoke consent, and housing authorities must have a policy for that situation when a family does revoke consent. There is also a new policy with HOTMA that EIV is no longer required to be used at interims. Makes our life somewhat easier. HOTMA has rolled out a new safe harbor income verification policy, and this is something that you don't have to wait for the HOTMA compliance date to implement. You can implement it now as long as it's in your policies. Where housing authorities can use income determinations from other means-tested programs to determine family income. The document that you use, if a family is providing a benefit letter, it must state the family size and be for the entire family. However, the income does not need to be broken down by family member or income type. And that income determination from that other program must be conducted in the prior 12 months. You then take the income that's on that letter, and then you apply the appropriate deductions or adjustments to that income. One thing, if you do opt to use this, the family does not need to report any changes in their income since that determination. So if they gained a job, for instance. However, they must report any changes in income following the re-exam. I know some housing authorities have done this and they think it's working pretty well. I know others that have chosen not to. The one thing I will say is if you are using this, the implementation notice does say that you can use LIHTC income determinations. I would strongly recommend you not do that because LIHTC tends to include a lot extra income that we don't include in the public housing voucher programs. And then my final slide, before we turn it over to Blake to lead the Q&A, there are finally in the HOTMA implementation notice changes to the verification hierarchy, which I know we all wanted to talk about on a Tuesday afternoon. So there's a new verification type, and this is technically the highest verification level in the verification hierarchy, which is that if a household self-certifies to what EIV is saying their income is, the housing authority or the multifamily owner can use that information, and the household does not need to provide anything else. So if your research specialist prints out EIV ahead of time and says to the Jones family, this is what EIV says your interim is or your income is, do you agree? And the household says, yep, that looks right. They sign the paper, they self-certify. Your income reexamination is done and dusted. So hopefully it could simplify some things, particularly with families who have relatively simple income situations. Uh, Once HOTMA goes live, there will be a new policy that benefit statements like SSI are now accepted as long as they are in the same benefit year as the annual reexam. There's also a policy when HOTMA goes live that housing authorities will no longer need to conduct periodic zero income reviews for families who claim zero income. You can just conduct annual income reviews. You can still use zero income worksheets, but you don't have to do anything between annual research for those families. And there are also new flexibilities for Social Security number verification. So when HOTMA goes live, housing authorities will be able to allow tenants who can't provide verification of their Social Security number. What you can do is you can allow the tenant to self-certify their Social Security number and provide one official document with their name. If you take that information and it's a match in EIV, you're good. You just need to document in the tenant file that the tenant self-certified their Social Security number and it matched in EIV. Because I know certainly folks on the ground know that when you work with tenants, a lot of them don't have their Social Security card. However, if you accept self-cert and it doesn't match an EIV, that you don't have a name and social match in EIV, then the tenant will have to obtain a valid Social Security card or some official documentation with their Social Security number on it. So that was 52 minutes of HOTMA information. Thank you for sticking with the end. I'm going to turn it over to Blake to talk about the conference and to lead the Q&A.
Thank you very much. Yes, so before we begin the Q&A, we would like to remind everyone that the early bird registration for PHADA's annual convention ends next Friday, May 15th. So if you have not yet, please register now to get the preferred rate and also get your hotel reservations in before the rooms are sold out. There will be a HOTMA session at this year's annual. It's titled HUD's Next Moves, Compliance Shifts, and What Housing Professionals Must Prepare for Now. And that will take place on Friday, June 12th from 10:30 a.m. until 12 noon. So again, if you've not yet registered, we encourage you to do so today, and we look forward to seeing all of you in Chicago. And so now, without further ado, we will move right on to our questions. So we did get a lot in the Q&A here. We hope to get to as many of them as we can, and we will start right now with this first one. So at one point, there was an indication that for garnishments against SSA benefits under HOTMA, we could count only the actual amount received instead of counting the full benefit. This isn't in the verbiage of the regulations as far as I can see. Do you have any information on this?
I need to double check that, Sarah. I know there was some back and forth with HUD, not so much with garnishments, but there was one of the early drafts of the HOP implementation notice. There was something about child support. It was something about child support, and if they didn't get the child support that they were promised, whether that was included. Let me double check the garnishments under SSA because I do want to see where they landed on that. Because there was, like I said earlier, there was a lot of back and forth. I think in general, the answer has been that what's income is what they get. It's not what they should have gotten. But let me double check that for you, and I'll follow up afterwards.
Great. This next question. Do we have an option for a higher asset limit for current families, or does it have to be the HUD limit?
It has to be the HUD limit.
Okay.
And again, that will change in October for Jan 1 of next year.
Okay. Next question, does HUD or PHADA have an example letter for notifying residents of these changes?
So FADA does not. HUD, like I said earlier, there was kind of we all kind of were rushing to get ready for HOTMA. I think in 2024 it was, and there was a ton of resources that were published on HUD Exchange. As far as I know, those resources are still up. So if you go to the HOTMA page on HUD Exchange, there's quite a few resident messaging documents. The one thing I will say is that because a lot of these things are subject to inflation adjustments, just make sure that the numbers in those, for instance, around the asset limit, are still accurate.
This is with calculating the net cash value. How do you calculate the net cash value? Is it through appraisal, use of tax records?
Typically, I would use appraisals. Um, it's typically what I've used in the past. I would say it's whatever is in your policy and just however you treat property right now, but typically tax records or appraisals, tax appraisals, I guess.
Okay, this next question. If tenants have a golf cart they use like a regular vehicle and no other vehicle available to them, does that count as one of the necessary assets?
As far as if they're using the golf cart to get to work, to get to medical appointments, to get to the store, then yes, I would consider it a piece of necessary property, and I would exclude it from assets.
Um, this next question, can a family request a waiver for FSS escrow purposes if they want their rent to increase?
No, the HOTMA implementation notice specifically prohibits housing authorities from doing that.
Okay, next question. Can we still do zero income reviews if we would like to?
Yes, nothing is stopping you.
All right. Next question. A scenario was provided about adding a spouse, but not the income. What about removing a spouse that had income?
Uh, yes. So if we do that example I gave in reverse earlier, so let's say she divorces her husband moves out, her husband a $20,000 job. Yes, you would remove the income in that situation. You just you wouldn't increase the income.
Okay. Uh, question. Where will the annual adjusted asset limit be posted?
So HUD has a website. I'm sure we can provide it in a resource document going forward. But if you just Google HUD passbook rate, because they put the passbook rate on there every year, it will be on that website. And they update it, like I mentioned, every October, give or take.
Okay. Next question. If an HA has a policy to process increase after decrease, do you use full new income or is income capped at original income?
I believe you use the full new income for that.
Next question. When is the new household composition interim rule effective?
So that,
ASAP? Oh, sorry. Yeah,
oh
go
no,
ahead.
sorry, that will be effective after the HOTMA compliance date. So uh, in theory, Jan 127 for most housing authorities.
Okay. Regarding food stamps, WIC, etc., can they be now be used as income?
So you can use the benefit letter. So if the benefit letter um, from their, let's say their food stamp says that the household income is, $20,000, as long as that benefit letter is from this benefit year and it lists the household size, you can take that $20,000 in that instance as the family's income and then apply deductions or adjustments to that.
This next question, household composition interim. At the next annual, if the job is no longer in place for the added family member, is it ever counted?
Uh, no, no, it is, in that case, the wage income is just the friends we made along the way.
Okay. Next question, when will the updated 5.8 and HIP system be available?
So SIP is no longer. I would say that software vendors are diligently working to update their software. Um, they are working very hard, so I don't want you to start bothering them, particularly because I know a couple of them are on the call. So they're all working very hard to meet these deadlines and the shifting guidance from HUD. So the 5.8, there is an updated 5.8, the 2024 version of the 5.8. There are some changes that are pending to that. But in terms of the new software system, I would be in touch with your software vendor. But again, they are all working very diligently. They are all aware of these changes. So don't feel like you need to go uh, email them today because they're working hard and they know what's coming.
We have time for one or two more questions. This one, when do the HOTMA changes take effect?
So HUD is currently targeting Jan 1, 2027. This should be published imminently for non-MTW housing authorities that are not using the family reporting system. And that would be for research with an effective date of Jan 1, 27, meaning that housing authorities will have to implement them sooner.
Okay, we'll have time for two more. How would the Social Security SSN number flexibility work for applicants?
So, and I know this is a situation that we ran into a lot when I was in North Carolina. Oftentimes our families come to us, they don't have their social security number now, particularly because of fears about identity theft. So a lot of places aren't printing it. So what a person could do, let's make it easy. Let's make it a single person. They could say, my social security number is this. So they self-certify and they provide an official letter with their name on it. The housing authority then takes their social security number that they provided, they've self-certified, and their name on an official letter, let's say a benefit letter. You put that in EIV. If it's a match, so if EIV comes back and says, yep, we found this guy or gal, um, you're good. You just document in the file that the tenant self-certified their social security number, and it was a match in EIV. If it's not a match, then the tenant has to go and get, I believe there's a time frame, I forget if it's 90 or 120 days. They have a time frame to then go get their social security card or their social security number verified through some other method. And if they're not able to verify it after that period, then you would have to terminate them.
All right, last question. With the 24-month phased-in relief, was it an automatic increase to 10%, or will it be implemented as 5% in the first year, then 7.5 in the following year? Can this be elaborated on further?
Yeah, so certainly if you look at the HOTMA implementation notice, there's more examples, but if they are receiving the elderly or the medical or the disability deduction, their first recert after the HOTMA compliance date, they get 12 months at 5% and 12 months at 7.5% before they're at 10%.
All right. Well, we have a lot of questions still. We are going to work on getting answers to those in a timely manner following this webinar. A reminder that we will also be posting a recording of this webinar on PHADA's website shortly. So, in closing, we would like to thank everyone for attending today's webinar. We had a lot of people on here and a lot of questions. We do hope that you found this discussion helpful. A reminder, if you do have additional questions, we encourage you to reach out to PHADA's policy team at any time via email. You can send it to policy@phada.org. And we would just like to say finally, before we go, we're inviting everyone here to please take the survey using the QR code that'll be on screen momentarily. Your feedback is very helpful for us in preparing future webinars and town hall events like these. And we will also be sending a link for the survey in an email following today's event. With that, we thank you all again very much for attending today, and we wish you a good rest of your afternoon.